Yeah. Okay. Right. So we're looking at 2015 now. I think the easier one for me is the deferred tax note. So let's start with that one. Okay. Quickly just identify all the items that have deferred tax consequences. That would be our depreciation on the buildings and the machine. It would be our provision, prepaid expenses, and the provision for warranties. Those 4 items. Everybody happy with that? Right, so let's start then with my deferred tax calculation. I'm going to work off the actual solution just because it's a lot neater. Let's start with our calculations. I closed my other ones. I shouldn't have done that. Okay. Let's just try and see where we can go from here. Right, let's start with the building. To recap, I'm just going to read through the information for us again. It said that the proceeds from the sale of the building was 1.5 million on 30 November 2014. This now falls within our current financial year. Okay, so the first thing we know we have in this financial year is a capital gain. Everybody happy with that? Okay. The building the building cost 1 million on the 1st of September 2013. Depreciation was applied at a rate of 5% per annum straight line. SARS allowed wear and tear of 10% straight line pro rata. Now, for 2014, we had we started with our opening balances for the building, and that's going to be our starting point for 2015, right? So, for our carrying amount, we had 975,000. For our tax base, we had 900,000. If you're wondering where I got that, that was from the calculation we did for 2014. You guys happy with that? Okay. Then in terms of depreciation for this building, they told me in my trial balance, depreciation for the building was 37,500. So I'm going to deduct that from my carrying amount, 37,500. And then they said that they sold the building. If the building is sold, what's the carrying amount of that building? 0. So whatever's left was then obviously sold, and I'm left with 0. Okay? Same story with my tax base. I don't even have to calculate what the wear and tear would have been. I just know that, sorry, something's bitten me. I'm going to end on 0. Right, so in terms of my deferred tax calculation, my building has 0 carrying amount, 0 tax base. Happy with that, because I don't have a building at the end of the year. Right, that's the first one. The second one we had was machinery. Again, my starting point will be last year's closing balance. So in terms of my carrying amount, I'm going to have machinery of 600,000 and 410. 600,000 is my carrying amount, 410 is my tax base. Looking again at the information provided, firstly, they gave me the depreciation current year of 120. Okay, so 120 is my depreciation, and then SARS allows wear and tear 20% per annum at a cost pro rata. We calculated that also in the previous 2014 year. That was my 110 times 20%. Same this year, it'll be 220. Everybody happy with that? Okay. Okay. Right. So remember when we were doing the 2014 financial year, we had that whole calculation where we said the cost of the building was 1.2. What we sold was 100,000. So we were left with 110, and they depreciate that at 20% per annum. So we calculated wear and tear, sorry, I said depreciation, I mean wear and tear, to be 220. And because it's the same every year, 220 is my wear and tear for 2015 as well. Happy? Right, so that leaves me then, I'm thinking this is 190 and 480. Right, slot that into my deferred tax calculation. 190 tax base, 480 carrying amount. Right, the carrying amount is larger than the tax base. That means in future I'll have more income than deductions. In other words, in future I'm going to be taxed on that income. So the 290,000 is taxable. Okay, and that'll lead to a liability. Everybody happy with that? Okay. Right, so we have then dealt with that figure and that figure. Everybody happy with that? Okay. Right, next we are dealing with a provision for warranties. Right, in terms of my provision for warranty, my carrying amount, everybody is happy with the fact that it's 80. Warranty, is that a provision for warranty, asset or liability? Liability. What's the tax base of a liability? Deductions. Okay, carrying amount, 80,000. When will I get the deduction? When it's paid in the future. So future tax deductions, 80,000, and that gives me the 0. Happy with that? Right, so furthermore, I know that I'll get this deduction in the future, so that's going to be a deductible temporary difference in the future, right? And so this is a deductible temporary difference, which leads to an asset. Happy? Okay, then prepaid expenses was 75,000. Is prepaid expenses an asset or a liability? Asset. Right, so it's an asset. My carrying amount is 75,000. When will I get the tax? What is the definition of a tax base of an asset? Future tax deductions. What are my future tax deductions? When will I get them? When it's paid, so I already got them. So how much am I getting in future? Nothing. Right. So in future, I'm going to have expenses, which I deduct off IFRS, but I have to add them back for tax purposes. So I won't get the deduction in future. So this is a liability to me. Okay? Taxable temporary difference, deferred tax liability. Happy? Right. And then you get to your total amount over there, and that is going to be a liability. Everybody happy with that? Okay. Before we carry on, let's quickly just have a look. Okay, no, let's carry on first, and then we'll come back to this. Right, so that was the first calculation, our deferred tax calculation. The next calculation is our income tax calculation, going from what is my profit before tax to what is the taxable income. Okay, first start with profit before tax. That has been given to me in my trial balance. I've got a credit of 1 million. Happy with that? Okay, so 1 million is my profit. Right, remember my tax rate has changed to 29% now. Okay, right. The next thing we have is permanent differences. Okay, so what have I included in profit that will not be taxed by SARS? And the only thing we had was our dividend revenue of 10,000. Okay, happy? Will not be taxed by SARS, so I deduct that dividend. All right. Then I come to my foreign income, right? We have foreign income. Will it be taxed by SARS? No, it'll be taxed by the foreign entity. So foreign income of 150,000 will be excluded. Right. And then the other thing we need to remember in that calculation is my capital gain. All right? We said that included in this million would have been the profit from the sale of that asset. Okay, and now this is going to be a little bit more lengthy. In terms of the profit from the sale of an asset, okay, there's a difference between my capital gain and my profit for IFRS purposes. Capital gain is selling price minus base cost. We said selling price of that building was 1.5 million, remember that? Base cost, 1 million. So, capital gain, 500,000. All right? Now, how do I calculate the profit? Again, I start with my selling price, but I deduct my carrying amount. Okay, so the carrying amount in this case would have been, where did I do that calculation? Back over here. Remember I said I've got the 975 minus 375, and the difference there, 9, 3, like that. Okay, so that would have been my carrying amount, 937,500. If I deduct that, I'll get to the profit on the sale. The sale amount minus the profit. Oh, okay, you could have done that as well. I was just getting to that. So remember that they gave you the actual profit, 562,500. That's the profit you recognized in IFRS. Is everybody comfortable with that? Okay. Now, can you see that my capital gains is not equal to my profit? Okay. This portion of the capital gain is going to be taxed at capital gains rates. Everybody happy with that? Okay. So what we're going to do with that 500,000 is we are going to include it at the capital gains tax rate and exclude it at the 100%. Okay. You can see all of that 500,000 is included in that profit, agreed? Okay. So that 500,000 is going to be excluded for capital gains purposes. And later on, I'm going to include it. Remember, the capital gains tax rate is 50%. Okay, 50%. The formatting here looks a little bit different. I want you guys to still do that capital gains tax at 100 at 50. Okay, just your little block thing. All right. Everybody happy with that? Okay. Now what I want to quickly just mention to you is if I do, think tax now. If I do sell this building, right? This is my profit. This is my capital gain. The difference there is 62,500. Where does that 62,500 come from? Obviously, it's the difference between my base cost and my carrying amount. All right. Similarly, for tax, we have the same thing. Remember, we have wear and tear for tax. So whatever my wear and tear for tax purposes is, I think it's going to be like 200,000 if I'm not mistaken, right? That 200,000, okay, what SARS what SARS does is they say, okay, you've got a capital gain of 50,000. This is what we're going to calculate it as. But in the past, I've given you deductions of 200,000. What do I expect from you in terms of those deductions? I want them back. You've sold your asset, give me back my deductions. We call that a recoupment. You guys have heard of this in tax. Okay. Now, remember I showed you this long calculation. Okay? The one you don't need to know. Okay? Just for interest's sake. Here's your 200,000 recoupment, and there's your depreciation difference. Okay, can you see that? So the full 562, your total profit has been excluded. You've included your capital gain, and you have added back your recoupment. Okay, so what basically I'm telling you is that this calculation we're doing over here, where we take the movement in temporary difference, is exactly the same as doing this long calculation. Okay, everybody got it. But like I said, this one you don't need to know. Cool. Everybody still on track? Right. Now I've lost what I'm busy with. We were busy here. Right, and then I need to account for my movement in temporary differences. This is now where I go back to my deferred tax calculation, and I need to say, right, so I want my movement from 2014 to 2015. Start with my opening balance. In 2014, I had a liability of 52,500. Happy with that? Okay, that goes with a change in tax rate and a movement in temporary differences, and my closing balance is 82,650 liability. Comfortable. Right. Did we have a movement in temporary in tax rate? A change in tax rate? Yes. It went from 30 to 29. So my tax rate reduced. So if I had a liability of 52,500, will I have a bigger liability or a smaller liability? Smaller liability. Okay. So how am I going to calculate that liability? I want it to go from 30 to 29, right? In this calculation, I only want the change. So what do I want? I want to know what is 1 over what do I have? 30%. So 52,500 times 1 over 30 gives me 1750. Is that fine with everyone? Okay. So my adjusted opening balance, I think, is going to be like 50,750. Everybody happy with that? Okay. Hmm? Yeah. So what I want to get is I want to know what the change is. So what was the change from last year to this year? So I'm taking the change over what I have is the old. Okay. Alternatively, what you can also do, and then you will get the adjusted opening balance, is you can say, I've got 52,500. I want to know what is that at 29% if what I have is at 30%. And that's going to be 50,750. Okay, still liability. You guys happy there? Okay, right. Then, so let's just put the adjusted opening balance there, 5750. And now the movement between those two is going to be my movement in temporary differences. That's going to be 31,900, moving in a liability direction, making my liability larger. Everybody happy with that? Yes? Okay. But what do I want in my calculation? I don't want the after tax rate. I want the before tax rate. Agreed? Okay. So how do I get this as a before tax rate? I need to net it up. What do I have? 31,500. That is how much? 30%. So I want 100. I've got 30. Happy with that. Times 100 over 30 gives you 110,000. Everybody happy there? Okay. That's where I get my 110,000. Sure. By, oh, yes. Good point. 29. Sorry. I want to times it by the, divided by the new tax rate. 29. Makes more sense now. Okay, great. Everybody happy now? Sorry about that. Okay. Right, so we deduct the 110, and that then leaves us with our total. Remember I said those two needed to be at the top. So my total there is going to be 480,000. Does SARS expect me to pay tax on the 480,000? No, because I have a loss from last year. So I can deduct last year's loss. 270,000. Everybody happy with that? Okay. That leaves me with 205,000, and that, at my new 29% tax rate, is the tax that I'm going to have to pay. Can someone quickly calculate that for me, please? 59450. Okay. Going to use this figure just now. I'll get back to that. Okay. The only figure we haven't worked back yet is this one. Okay. Where did we get it initially? In 2014's deferred tax calculation. Right. So in 2015's deferred tax calculation, do I still have an assessed loss? No. Okay. So that moved. That's now 0. Okay. But remember how we did this separately and that separately from the assessed loss. Okay. So I've calculated now the change in tax rate of everything except the assessed loss. Remember, this asset I have, when they changed the tax rate, reduced my asset as well. Happy with that? Okay. So we need to now do that. Okay. The opening balance was 82,500. I want the change. So times 1 over the old rate, 30. And that gives me 2,000. Please ignore my brackets. That was not right. It is an asset. Sorry. It's not in brackets. It's an asset. It's going from 30% to 29%. Am I going to have a bigger or smaller asset? Smaller asset. So I'm reducing my asset by 2,750. Is everybody happy with that? That then leaves me. Remember, my closing balance is 0. That means the rest I should have used during this year, and I think that's 79250 or 79750. Let's quickly check. 82,500 minus 79750. 79750, that's what I used. Everybody happy with that? Okay, right. So we've done our calculations. We've added all of these up. Can we go to the notes? You guys happy with slotting it into the notes now? Okay, right. So let's start then with the note. First, current year tax. That comes from the calculation I just did. $59,450 from this calculation goes directly into my note, and I obviously circled the wrong thing. 59,450. Right, that's the first one. We did not have an under or over provision. Are you questioning or just okay? And then, so no under or over provision for 2015. Foreign tax, right? And this, if you want to do it this way and not jump between, you need to know your format 100%. Did we have foreign tax? Yes. What was my foreign income? My foreign income was 150,000. 150,000 times 45% will give me the tax that I need to pay to the foreign entity, 67,500. Okay. Movement in temporary differences. Right. When I did my calculation, we got to 31,900. How did we get that? All the way back here. Apparently not. Where did I do that calculation? Maybe on this side. No. Yes. Oopsie. Damn it. There we go. 31,900. That was the movement in my temporary differences, excluding my assessed loss, right? Okay. That movement in temporary differences is moving in a liability direction, right? So credit liability, debit, income tax expense. Happy? That means the 31,900 is going to be positive because it's increasing my expense. Happy? Right. Then my change in tax rate. Now I include both assessed loss and normal. Remember the one was, let's go back to that calculation. We got 1,750, which was positive, minus 2,750, right? 1,000 over there. But remember, this is making my assets smaller, right? So let's quickly do these two journal entries just to illustrate. Okay, so first looking at the 1,750, I'm making my liability smaller, right? How do I make a liability smaller? Debit, deferred tax liability, 1,750. Credit, income tax expense, 1,750. Right, now I'm making my asset smaller. How do I make an asset smaller? Credit, deferred tax. Asset, 2,750. Debit, income tax expense, 2,750. So you can see here, my income tax expense, right? Debit is larger than the credit by 1,000. Happy with that? Okay. And that means my debit is expense. So I'm making my expense bigger. That's why I have it positive over here. Am I in the right place? I'm not. Bigger over here. Happy. N. Oh, this. It's NORM, normal. Okay. Happy? Right. Assessed loss. Now I utilize that as assessed loss. Remember, what would the journal entry have been when I used it? Okay. Debit and credit. The credit, I had an asset. I'm reducing that asset. So I'm reducing my deferred tax asset, debiting my income tax expense. So this is making my income tax expense bigger. Happy with that? Right. And remember, this is at the 29% rate, not the difference. So you'll see there will be a difference. Happy with that, guys? Okay. Right, and that's the first part of it done. That adds up to 239,600. This thing has to agree with the other part of my note, and this is the number that goes to my profit and loss statement. Right. Okay. From the million profit that I made, I would have expected to see tax of 290,000. I didn't have tax of that. We just calculated that my income tax expense is 239,600. Okay? How did I get to the difference? The first difference would have been my permanent differences, which is my dividend income. Right, now I'm working from my 29%. I've got a dividend income of 10,000 times that 29%. I reduce my tax liability with 2,900 because it's not taxable. Happy. Next one I have is my capital gains. The capital gains I had was 500,000. All right. Capital gains at normal rates was the 500,000 times 29%. I'm excluding that because I won't pay that. Happy. What I will pay, however, is 500,000 times 29% times 50%. Everybody happy with that? So what I'll be deducting in total is half. Okay. change in tax rate, we've discussed that. It's already at 28%, so only slot in that 1,000. No over or under provision. Foreign income, I made 150,000 rand in a foreign country. They tax, South African tax rate is 29%. That's what I won't be paying tax on. What I will be paying tax on is 150,000 rand times 45%. Include that. Right. All of that added up will give you 239,600. Okay. The last thing that we do just here, which I haven't yet talked to you about, is my effective tax rate. So what I want to know is the tax rate in my country is 30% in this year and 29% in this year. How much tax am I paying? Last year, 40%. Obviously, that's a minus. This year, 23%. How do I get that? I say 40,000 over the 100,000 loss. Right? So I take my tax expense over profit or loss. Same thing this current year, 239,600 over my million rand profit. Okay, a lot of companies you guys will see, that's like a big thing for the companies. They want to have as low an effective tax rate as possible. Okay, that means they are most effectively using their tax rebates and so. And what a lot of companies do is they open subsidiary companies in Cayman Islands where there's basically no tax rate, or in all these other tax havens. Mauritius I know is one. Sweden, I think, Cuba. So that's basically how they do it, and that's what they want to see. How effectively are we actually managing our tax expense? Everybody happy there? Cool. Yes. You just show it as a positive because it's still 40,000 over a year. All right. If one of these were other way around, then you would. That's unlikely. Okay, and then just my deferred tax note, exactly as from my deferred tax calculation. All right, did this way make a little bit more sense? Okay, how are we feeling? Okay. Huh? On the border. Hopefully not of Zimbabwe. Right, so